Good morning, everyone. My name is Alaya, and today I'm going to review a McKinsey article titled Valuing Cyclical Companies, written by Marco De Heer and Timothy Kohler. Without further ado, let's get started. Okay. So here are the table of contents. Moving to the background of the article. So managers and investors face unique challenges when attempting to determine the appropriate valuation for companies operating in areas susceptible to large fluctuations in profitability. In difficult situations, businesses in cyclical industries challenge the basic rules of valuation, especially when the behavior of their shares seems unconnected to the discounted value of their underlying cash flow. Next, summary. So first is DCF and cyclical companies. Much like high-growth internet startups, cyclical enterprises can be valued using a modified discounted cash flow method. The underlying linkages between cyclical companies' cash flows and share values, as well as the potential role of security analysts in biased market expectations of performance will be examined first. So the fluctuation pattern comparison of free cash flow and DCF value shown in this graph indicates that the underlying cash flow is far more volatile than the DCF value. Since DCF value is not greatly impacted by the performance of a single year, there is in fact very little volatility in it. Low cash flows are cancelled out by high ones. So the long-term trend is all that matters. However, in reality, cyclical companies' share price are less steady. 15 corporations with 4-year cycles have their earnings and share values index displayed in this Exhibit 2. It appears that the theory and reality are at odds since share prices are more volatile than the DCF technique would have predicted. Consensus profit estimates frequently show an increasing trend, regardless of whether a company was at the peak or trough of a cycle, seemingly ignoring cyclicality completely. An examination of 36 US cyclical companies from 1985 to 1997 served as the basis of this finding. Researchers contrasted projected and actual earnings during the duration of the cycle. Referring to the previous example, the actual and projected consensus earnings for 15 companies in the transportation equipment or primary metals manufacturing sectors are plotted in Exhibit 3. Each cycle lasts 4 years. The earnings cycle is not at all predicted by the consensus forecast. Earnings per share are actually predicted to continue a straight upward trajectory, with the exception of the estimates for the next year in the years near the bottom of the trough. Even the presence of a cycle is not acknowledged in the forecast. And here is my personal opinion. So reading this article made me realize that there are biases in analyst research. Analysts fear the negative impacts if they produce negative research results. Then second point for valuation procedure, I agree with the valuation procedure of building two scenarios and weighing their values. In the first scenario, we suppose that the industry will decline during the next year or two, and that the cycle will repeat itself with a 50% likelihood. Under the second, we assume that given the current increased performance, the industry will break out of the cycle and pursue a new long-term trend, likewise with the 50% likelihood. The company's value is weighted average of these two figures. There was proof that the market does see such issues in this manner. Last is solution to business hesitancy. So businesses in the real world are hesitant to adopt the opposing viewpoint. Here are some solutions. First is encouraging a culture of critical thinking, make decisions based on data, assign compensations for risk-taker executives, and consult with third parties. Next is lessons learned from the article. So first, forecasts of profits have a generally favorable bias according to academic research. So this is occasionally attached to the demands placed on investment bank stock analysts. And then second is a business or industry might exit its cycle at any time and enter a new one that is either greater or lower. And then there are 3 ways to value the the 4-year cyclical companies. So first is with perfect foresight about the upcoming cycle, and then second is with zero foresight, assuming that current performance represents a point on a new long-term trend, essentially the consensus earnings forecast. And then last but not least is with 50% perfect foresight and 50% zero foresight. And then also, managers make cyclicality worse by starting big projects at high prices and pulling back at low ones. And then before implementing a plan to issue shares at the top of the cycle and buy them back at the bottom, managers could first plan their capital expenditures. So the most aggressive managers could take this one step further and adopt a trading approach, acquiring assets at the bottom of the cycle and selling them at the top. This might more than double the returns for a typical company in a cyclical industry. And then last but not least is businesses in the real world are hesitant to adopt the opposing viewpoint, as I've mentioned before. When the future appears bright and competitors are growing, it is difficult for CEO to convince the board and investors to expand when the outlook is negative and to pull back when things are looking good. Therefore, while it is feasible for a company to break out of the business cycle, only a very few CEOs can be able to do it. And that is all for the article review. Thank you for watching and listening.